Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Thursday, August the 28th. Welcome to our Global Markets Commentary. August's heat wave extended to global equity markets as good news outweighed the bad, and even the negatives were spun into positives. Of course, good and bad news as far as equity markets are concerned only applies to the things that equity markets care about, namely corporate earnings growth, economic growth, and interest rates. Bond investors, oft seen as the more cerebral crowd, didn't celebrate as wildly as equity investors. But here too, the takeaway was better than a first glance at the headlines would suggest. Capital markets took notice of three key developments in August: a better outlook for global growth, solid corporate earnings, and the prospect of lower borrowing costs. First, global growth. Recession fears are off the table. In fact, we may have seen the worst of any slowdown back in Q1. Business investment is humming, governments are juicing economic growth with fiscal stimulus, and consumers continue to spend. Next, earnings growth. Corporations are churning out earnings growth. The question that markets are answering by pushing to new all-time highs is, if earnings can remain strong through all the uncertainty, how much better might things get if the headwinds dissipate? What if the quarters ahead bring better growth, less tariff uncertainty, maybe even less geopolitical uncertainty? Equity markets aren't cheap, but earnings growth is delivering. Consider that forward price-to-earnings multiples for the S&P 500, S&P TSX Composite, Eurostoxx 600, and MSCI Emerging Markets Index are currently below their earlier year highs. Last but not least, and certainly the most significant short-term catalyst, lower interest rates are coming, and with them, all the liquidity and economic boosting benefits they bring. The media is spilling a lot of ink on the drama unfolding at the U.S. Federal Reserve. Resignations, firings, maybe, and the new appointments that these will entail. Investors left these details to the academics and simply cut to the chase. Rate cuts are back on, with Fed Chair Powell leaving little doubt that September will see a resumption of policy easing. What about Fed independence? The reasons why interest rates are being cut matter. Conspiracy theorists argue that interest rates are being lowered due to political pressure, potentially jeopardizing the Fed's independence, which may lead to higher inflation. However, equities are an excellent inflation hedge. So on that basis, the stock market can ignore a mildly higher inflation regime. In fact, it may even welcome it, as it can open up pricing power. The rub for stocks is higher rates and bond yields. But that's the point. A politically beholden central bank is going to let inflation run hot and keep rates low. Investing in stocks is a logical response if this is the scenario. We like stocks for the long term for many reasons, but this is on the list. Aside from higher inflation, and to be clear, we're talking about higher than 2%, maybe 3%, not the 8% spike of 2022. There could be longer-term consequences of whittled down Fed independence. The US dollar could weaken, and long-term bond yields may rise. The US dollar index is unchanged from late April, and 10-year government bond yields fell in August, while 30-year yields were flat. So there is no evidence that the negative consequences are percolating in the here and now. Equity investors took this as a win and focused on the Fed easing. To sum it all up, a better growth outlook, a strong earnings season, and easing financial conditions on the horizon led to global stock markets soaring higher. That's the way we saw the month of August. Thank you for joining us. We look forward to you tuning in next month.